Car buyers have literally been slammed in the last 3 years with the car market. First of all, they had a little extra money and then they couldn't find a car because of chip shortages. Then along came higher interest rates and inflation. MSRP started to rise because of the lack of available vehicles, and then customers found them paying 50% more for some certain models. They also found themselves paying more for used vehicles just because they were available than some of their counterparts that were brand new. Customers and consumers have literally been getting crushed in the last 2 to 3 years. But the latest one is literally a vast majority of consumers now who have taken a significant amount of money as a car loan on their car borrowing opportunity are literally underwater. That's right. Have you heard of negative equity? So there's a significant amount of buyers now that are underwater. People were buying cars at a price that they probably shouldn't have been buying. The last 2 years, car manufacturers have been jacking prices up. MSRPs were high. They were literally tacking on at the dealer level, at the manufacturer level, tacking on extras, market adjustment fees, and all these other widgets, paint protection film, gap insurance, ski bags, and floor mats, as well as tint, were all examples of things that a lot of the local dealers would literally tack on to the bill of that new car that you bought. Now, a lot of those parts don't give you any value. They don't represent any value. When you sell the car, those items aren't worth anything to the next buyer. I mean, sure, while it might have some value that isn't necessarily written on paper to a buyer. I mean, if you have a car that has all the extras, it might be easier to make a decision as a buyer coming in choosing car A with all the widgets or car B with no widgets. But at the end of the day, it doesn't really impact value. But unfortunately, customers were getting snookered. Why? Because a lot of these cars were sitting on the lot. Not too many, because remember, supply was very low and demand was really high. So the dealers were in some ways regulating the velocity at which the cars were hitting the lot. They had cars that were sitting on the lot. They'd load them up, jack them up with racks and all kinds of extras, gap insurance, as I say, and a lot of those other widgets. And then you ended up paying a ton more money for a car that, if you really cut through all the cheese and the noise, you had the base MSRP and you had all this extra fluff on top, and people were buying that. And they wanted to buy it. They had no choice. They had this car sitting on the car lot. Either that or you wait 2 years. That's the conundrum people were facing with. And then along comes a little thing called inflation. And inflation is something that the only way you can counter that is by jacking up interest rates. That's what the bank does. Bank of Canada or US banks, they all do add these little tricks. It's one of their key levers that they can operate to affect inflation. But unfortunately, a lot of this inflation kept going. People were still buying. They were buying houses, they were buying cars and toys and boats and quads and sleds, but inflation kept rising. So manufacturers caught on and they continued to regulate the output of their car production, and people were still paying more and more and more for a car that really wasn't worth it. Now all of a sudden you have a situation where people were paying 8, 10, 12, even 20% for subprime borrowers for a lot of their car loans, whether they're going to the bank or in some cases buying it right at the dealer, if the dealers would even approve them. They were sometimes in a situation where they had these huge car payments, and you know what happens when you have huge interest and you have it spread over a long period of time, for example 7 or 8 or more years, you usually end up paying most of the interest at the front end, and very little principal gets knocked down until later on in the tail end of your loan period, which means that you could pay for a car for 2 or 3 years and really have little impact on the actual core value of that loan. And essentially you still have the majority of your borrowed loan or the base equity of that loan tied up, and it's still there. It's still equalized, and you haven't really affected it all that much in the first 2 or 3 years. Yes, in fact, I've personally known people who've taken on this situation. They literally bought a car at the peak value. They overpaid for it, and they bought it with a high interest rate. And next thing you know, two years later, they want to unload it because they're not really in love with the vehicle anymore. They go and they check the balance of their loan versus what the depreciated rate of that vehicle is now, and they actually are below water. In other words, they're drowning. Negative equity. For example, in November, people absolutely smashed the negative equity numbers and clearly have hit a number that we haven't seen in years. The average for that is $6,054. It's a bad place to be. For example, here's a great prime example. You have a car that's worth $22,000. You pay down 2 or 3 years later. All of a sudden you go and you check your balance, and you still owe $21,000 to the bank. But then you go check some of the resources for depreciation of a lot of these vehicles, and you'll find that it may only be worth now $16,000 because now that we've popped out the other side, we have these very inflated balloon values of these vehicles up to about 5 or 6 months ago. And now we flipped the page and now some of these cars are not being purchased. People don't want them as much as they did. Wholesale prices, auction prices are down. Dealers are not as interested in some of the older used vehicles anymore, and that transfers over to the marketplace. Even retail, people aren't buying a lot of the new vehicles. We know EV market are slumped and sales are down. We also know that a lot of ICE vehicles are just elevated in price. A lot of people don't want to buy pickup trucks or SUVs. They're overinflated as well. So now we have a situation, people are a little bit shyer to buy in this last few months, both used and new. And now, of course, that does directly impact depreciation of that vehicle. Supply and demand. Nobody wants it, the value goes down. So a lot of this underwater or negative equity is impacted directly by interest rates. The value people put in vehicles and how bad they really want to buy one all does impact how much people are willing to overpay and how much they are trying to jump ship. Now, there was a real strong urgency for people to start walking away from their loans because they see this conflict. They see how much they own on their loan. They see the cost of living. They can't afford a loaf of bread. They can't afford the rent for their house. So the next thing that has to go is their car loan. Well, the worst part is you pay $22,000 for your car. After 3 years or 2 years, it's only worth $15,000, like I said, and you still owe. And a huge problem is when people really need that money, they're cash-strapped economy, and they need that money for daily living, and they got to sell their car, and they're trying to cash out that car loan, and they realize that not only do they take the money that they can take from equity from that vehicle, or what they think is equity, turns into a negative equity, and they end up owing the bank more money on top of that. So in 2 years, they might have only chopped down about $1,000 of equity, but the vehicle's worth 15 grand. They might actually have to pay $5,000 or $6,000 back to the bank on top of the vehicle just to unload it. That's a really bad place. And a lot of people are finding that struggle is real right now. So what else really started to cause this problem of negative equity to a lot of consumers? Well, a lot of it was banks obviously started jacking up rates. Well, if you're in an 8, 9, 10, 11, 12% rate, as I say, a lot of the front end of your loan is going to be mostly interest payment. As well, they started extending these loan terms. You know, back in the day, it was 3, 4, 5 years was your typical time you would borrow to pay for your car. Now they're extending that out way beyond that, up to as much as 8 or 9 years. And according to Manheim Used Vehicle Values, since the peak in about 2022, we've now seen it tip over the ledge. As I mentioned, the average vehicle has gone down by about 20% on the used car market, which accelerated the depreciation for anybody trying to get out of their car, left them in even a further case of upside down into the lake. So it's really just the insult to injury. You know, a consumer will look at this 2 years into their loan term, as I've said already, and they see that they haven't made any headway. And they basically look at the lender and say, I've paid you how much every single month, whether it's $500, $800, $1,000, maybe even $1,500 a month, and I still owe you money just to walk away from this loan? This is painful, and it's hitting a lot of consumers. And honestly, a lot of consumers, their eyes went really big. They wanted that next shiny toy. So part of the problem is the consumer that just wanted to take on more than they could actually tolerate. Remember, I suggest always have a little more cash on hand so you're not having to borrow as much from the bank. That way you're isolated from those variable interest rates. But another part of the problem is the banks. The banks have been a major contributing factor to this, as well as a lot of the OEM and the manufacturers being just greedy, chalking up major profits, maximizing their input and their greed and their dollars and cents. They've made more than they've ever made. So a lot of the CEOs are just giggling all the way to the proverbial bonus bank. So clearly it's a situation now that we're in a rough spot. Defaults are elevating. In other words, a lot of people are walking away and the banks are taking the cars back because they just can't afford to make the payments. Even just delinquencies where people are coming up late 2 or 3 months and they're negotiating with the bank just to extend their overall loan term and their due dates. Even that is indication to what's going on. People can't afford it. Cost of living, house, food, cars. Schooling is another big consumer impact financially. And here we are in a situation where car is one of the first thing that has to go. Unfortunately, walking away isn't usually the answer, and the consumer bites the dust. And I hope you all enjoyed that right there. Check that one out. That's all about what's going on at CarMax. When CarMax fails, clearly that's a direct tie to what's going on in the consumer retail market. So you definitely want to check that out. Hope to see each and every one on the next one. We'll see you real soon. Bye-bye.